Happy New Year, everyone. Welcome to 2021, and we here at PairTrade Finder have been working very hard at the end of the year to deliver to you a new product, a new tool for subscribers to PairTrade Finder Pro, which will allow you to upload a great set of new pairs into PairTrade Finder Pro that will generate some pretty interesting trading signals for you to study. Let's have a look at what the Fast 50 US Equities pairs January 2021 vintage are. First off, what's it all about? As I just mentioned, when you now sign up to PairTrade Finder Pro, you have the opportunity to preload into your software 50 stock pairs. And these stock pairs in backtests over the last 12 months, so for the whole of 2020, generated 401 closed trades, and that's about 33 trades per month. So those of you who've been trading our top 30, you'll realize that these generate a lot more signals, roughly 4 times as many signals. Now these signals generated had an 89% win rate. The median winning trade was about $544, and these are done on $10,000 a leg. The median losing trade was only about $262, which gave a reward to risk of 2.1 times. Most interestingly, the net profit for those 12 months, had you traded this set, was $210,851, and that's based on, again, $10,000 leg trade size, and that equated to a 6.2% per month return on the average margin required to hold those pairs. So if you want to find out more about that, read on and listen on. What's new for the Fast 50, and why do we call them fast? I'm just taking a little segue here to understand what we've done and why we think you can get a lot more trade opportunities and have, with just this set, 1 to 2 good trade opportunities per day. So some Saxo Bank research done about 4 years ago showed that the past profitability for industry sector-focused stock pair trading reaches its maximums when using a 21-day look back. Now what we've done is, in a drive to further increase the daily trading opportunities for any given pair, and without sacrificing the reward-risk ratio, we've applied these 21-day lookbacks to the standard deviation and to the entry-exit stretch, but we have used a slower, simple moving average of the price ratio, and in this case 42 days. Now why have we done that? Well, essentially what that does, get back to this slide, apologies, is it slows down this moving average ratio line, so it becomes smoother and flatter over a given period of time, 365 days, versus the fact that when we're calculating standard deviation and entry and exit stretch, which you'll see here on the plus minus chart, 2.5 and minus 2.5 entries, these are generated looking back only 21 days, and this is generated looking back 42 days. So what does that mean? Is the moving average is moving more slowly than the calculation of the standard deviation and entry and exit stretches. Therefore, it's a little bit like putting a very fast moving dog around a slower moving owner. And what that does is it can generate more signals and more good signals. Why do we say that? Well, look, AMGN AZN, that's Amgen AstraZeneca, normally generates about 3 trades a year on our old top 30 settings. In this one, it generated 9 trades in 1 year. 8 of those closed as winners, and the final trade of the year is still open at this point. And here you can see, so there's the 42-day moving average. Here's the 21-day lookbacks calling each of these entries. So what you're getting is, when combined with our rigorous co-integration, profitability, and fundamental screening based on PairTrade Finder Pro software, you get a subset of high-octane pairs, okay? And that's what we call the Fast 50 US Equities pairs, okay? Take note, they are more higher volatility, and risk management will need to be tighter. We'll get into that in a sec. First, what do our customers say about PTF? If you're new to this video, if you're new to our software, let's see what others have said who've been using it in the past. There's El Coziel said, just to say how delighted I am with your product. For the first time in 10 years, I'm consistently profitable. That's what we're always hoping for, is to make traders consistently profitable. If I can sort out my discipline and stick with the signals, the results would be even better. Yours eternally grateful. That's a great thing to say. Chris Stone over here said, I'm amazed that more people are not using your software. I've managed to make $8,000 in the last 3 weeks. I credit that to you, your staff, the great videos, and the excellent software. Let me say that I love your product and I intend on being a lifelong user. I'm truly grateful. These are unsolicited customer input that we receive, and we're very grateful to receive it. If you guys have anything to say, positive or negative, send us in your comments. We take them on board, and we do everything we can to improve our offering. I like this one from Geoffrey. He said, I started trading the strategy in September on a Collective 2 account, and I also started the trading strategy on my own account at IB in October. I'm just glad that the strategy performs as expected. Backtest equals real time. Okay, so that's what people are saying to us without us even soliciting their comments. Hope you take that on board. There's some good things going on with PairTrade Finder Pro. How do we create the Fast 50? I'll take you through this quickly, but it's very important. You need to understand what you're doing. And when we create a pair that goes into the Fast 50, each stock pair has to meet stringent historical return, co-integration, and basic fundamental screening hurdles. Okay? So how do we do it? Well, we take a sample selection. We take these from FinViz. All NYSE Amex Nasdaq greater than $2 billion market cap companies, they have to have at least $2 million a day of average daily trading volume and be easy to borrow. And then we run them through a fundamental screen. What does that mean? We break down all of those above subset of tickers by national market, same sector, and usually same industry subgroup. So we rank them all by subgroup, and then we backtest everything that's within that subgroup. Okay? So what are the parameters we use for the backtest? Well, we do, for this group, we are using what's called a Fast 50 backtest. So we only do a 2-year look back period on the backtest. And we set the standard deviation and stretch lookbacks to 21 days, but we leave a 42-day look back for the ratio, like we said before. So that's a slower ratio, a slower moving average for the ratio, and quicker lookbacks for both standard deviation and stretch. Then we use a 2.5 plus or minus 2.5 standard deviation entry, a plus or minus 0.8 standard deviation exit stretch. So we're looking for about a 1.7 standard deviation move between entry and exit. We estimate 10 basis points commissions and slippage per trade. We've limited the max days in trade on these faster pairs to 30 days. And for all our purposes here, we've used $10,000 a leg. We do not apply an RSI filter, although that's something with these faster pairs you may want to look at. We'll get into that in a sec. So then we backtest them all, and what do we take? Well, the filters we put on the backtest are, they got to be co-integrated based on our definition, which means in PairTrade Finder Pro, the co-integration needs to read 0.90 or better, okay? You can go into the geek stuff here, but that number needs to be 0.90 better. For tolerances, we'll take 0.88 or better. Okay, average net profit per trade, we want it to be at least $250 and usually over $400. We also want to see a minimum 5 trades per pair over the 2-year period. Most of these are generating far in excess of that, somewhere around 15 to 20 trades over a 2-year period. And then the compound annual growth rate of the capital deployed just to that pair, we want to see that usually around anything over 10 to 15%, and we want it to be in excess of maximum drawdown. We look for positive reward risk, especially in backtesting. Later in real trading, you try and maintain that. It doesn't always work perfectly. The target max historic drawdown, this is a very important one, which is why we've put it in red. When you're trading these higher volatility pairs, you get bigger drawdowns. There's no doubt about it. We've selected pairs. All of them should have less than 20% historic max DD. Now that's really important because if you're looking to set a max loss stop loss, one could look at that and say, well, what's the worst the pair ever did anytime over the last 2 years? And if it's gonna get to a level where it's doing worse than that, well, then we want out because something's changed. If you're doing 10,000 a leg, that would be minus $2,000 on a trade. Now you see up here that the median losing trade in the backtest was only minus 262. So if we're talking about a max stop loss of minus 2,000, that's a very wide stop loss. Something that a trader might want to consider, especially when using faster standard deviation on a slower moving average. We look for a minimum win rate of at least 70%. We target at about 80% or more. And then we like to see correlation in addition to co-integration. We like to see it 50% or more. However, if the pairs are highly co-integrated, 0.98, 0.99, we might even take a negative correlation if everything else stacks up. So that's just to keep in mind. Then commissions and slippage, we want that to be less than 20% of gross profit. We don't want to give the broker any more than 20%. This is easier now. A lot of brokers are offering commission-free trading, and we're integrated with Interactive Brokers. They offer very cheap trading. If you're any kind of high volume, you can probably get it for about 50 cents a trade. So this is much easier now. So that's how we create them. Let's give you an example. So here's Amgen versus AstraZeneca, which is one of the pairs. So if you see here, we've got a 2-year look back, and we've got 15 trades in those 2 years. Look at the equity curve down here. You know, it's first trade drew down from the lowest point to where we are today. You know, it's a very steeply sloping bottom left to top right, and especially in the last 6 to 9 months, it's done incredibly well. We've got a 100% winners on this pair. Think about that, 100%. So there are 15 trades in the last 2 years, and 100% of them were winners. The correlation's up at about 79%. Co-integration, yes, it's co-integrated. The compound annual growth rate of the capital just deployed to this pair and nothing else was 23% a year, and your max drawdown on that was 8.36. Okay, so that's a pretty attractive positive reward risk. Total gross profit of 5,840. Average net profit of trade of about 347, and as I said before, 100% winners. Over here on the ratio chart, you can see just how the moving average ratio has just been pretty flat for almost the entire period, and that's what we like to see. Tons of crossings of the daily ratio against the moving average of the ratio. All those zero crossings provide great opportunities for trades. So what else did we get out of the screen for this pair? So this one here shows you that on a returns basis, from a financial point of view, this is a great pair to trade, and from a trading percentages win and the like, it's a great pair to trade. But do you have the underlying confidence in the fundamental correlation that the two companies really should move together? Well, Amgen, here we've taken this from our new feature in PairTrade Finder Pro version 2.2, which is our fundamental snapshot, and that gives you immediately a company description plus all of these metrics with just one click. So Amgen discovers, develops, manufactures, and delivers human therapeutics, i.e. drugs, worldwide. It focuses on inflammation, oncology, bone health, cardiovascular, neuropathy, neuroscience areas. Okay. AstraZeneca discovers, develops, and commercializes prescription medicines in the area of oncology, cardiovascular, renal and metabolism, respiratory, autoimmunity, infection. Okay, very, very wide range. These are also a very wide range. So they do the same thing. What are they like financially? Well, first off, one's in the USA, one's in the UK, but these are both traded on US exchanges. They're in the healthcare sector. They're both in the drug manufacturer subsector. Their price ratio are not too far out of line. It's about 4 to 1, 4.5 to 1. And importantly, the betas are very close, 0.76 to 0.6. And the market caps are almost identical. The enterprise values are almost identical. EV to sales is almost identical. EV to EBITDA is very close. PEG ratios are really close. The price to sales and price to book values are also very close. So the market's seeing these companies in exceptionally similar ways. Add on to that the dividend yield on both is almost identical, and the Zacks rank is 3 on both of them. Leads you to say that these are very similar companies being viewed by the market in a very similar way. That's what we call a fundamental correlation between the two that would lead us to have confidence that, barring any unforeseen, unsystematic single company risk that changes the valuation picture of any one of these symbols, if the ratio gets out of line, it's most likely going to come back into line with its historic averages, and that's what pair trading is all about. So here we just have a close look at the pair charts. Here's the latest trade. It's still in trade. That's saying 4 January. It's actually 31 December. It's about 127 profit at the end of the year. This is because of time differences on the computer. Here you have the plus minus chart, and you're seeing that every time it goes above about 2.5, we're triggering an entry. These lines are just a little bit off. Then on the ratio, this is important. You look over the last year, you can see that there's sort of an upper resistance and a lower support. So you want to be taking trades when it's near that area, although every one of these ones that were in the middle were also profitable. So that's the thing. When you're looking at these charts and you're using a slower moving average and a faster standard deviation and entry and exit stretch, the metrics are going to change a bit. You need to take that into account. On the RSI of the ratio, you see that in these two, it was at an extreme. You can look and see whether you have divergences, which are important, and we like to look for them. And then on these ones, it was also at an extreme. On these ones, it was not. So again, when we talked earlier about maybe you want to put an RSI filter on, if you're a little uncomfortable with how quick this strategy is, and whether we're just getting too many great pairs and great profitability historically by chance, and you look for a greater extension in the RSI or the ratio versus the moving average, you could put an RSI filter on and just take trades which are 30 or 70 and above. We have that capability in PTF Pro. You just put in your elements for the RSI filter, and it'll only call signals when that RSI is at a maximum. Again, maximum is interesting. The most important thing are divergences. So we encourage you to learn about that and look for those. Then here's a correlation chart, just shows, this last trade, would you take it? Well, correlation had broken down but was beginning to recover, and in any event was still pretty high, all over 50% throughout this whole period. So that's kind of a quick look at AMGN, AZN, and that's one of the constituents of the top of the Fast 50 U.S. equities pairs. So let's go through the backtest results. So this was for the full year last year, and what did we get? Well, with this 2-year backtest, 21-day standard deviation and stretch lookbacks, 42-day ratio lookback, 30 days max in trade, 2.5 entry, 0.8 exit. There were 100 tickers, no duplications. We got over 35 industry subsectors, so you have very good diversification. And they generated $215,353 of net profit before margin costs on the closed trades. That led to a win-loss ratio of 89% and 2.1 times median reward to risk. That's great. Interestingly, the median days in trade is about 12 days versus about 20 on the top 30, our previous top 30 sets. So again, faster trades and more of them. That's what you can say about the Fast 50. Let's go a little bit more into what that meant and how big an account you needed to run that. So let's look at the imputed return analysis for the year. To trade this set, we assumed that a required capacity for 40 open trades is necessary. That includes headroom. Here we go about calculating this. So there are 401 trades, median days in trade. The trades per month estimate was about 33 trades. We put a headroom, an extra 25%, say 40 trades a month. That means you need a nominal capacity of about 800,000. The margin required would be about 160,000, which is 5-to-1 CFD margin at Interactive Brokers. We add an extra bit of margin, another 25%, and say you would need 200,000 to be able to maintain open 40 trades and stay within margin limitations. So while we're talking about that, let's just highlight this. Scale leg size accordingly. If you're trading a 20 grand account and you want to trade all the signals as they come, you would need to scale down to about $1,000 a leg. Okay, that's really important. You can go to PTF, you can set your leg size, go from 10,000 down to 1,000, then the signals will generate on that basis. Okay, that's really important. If you had a 50,000 account, we would therefore trade these at about 2,500 a leg. That assumes you're taking all the trades and that you need that much headroom and margin space in your trading plan. Okay, if you had done so, which we think is a reasonable way to have a look at trading this set of signals, you had an annual return of about 106.5%, which equates to about 6.2% per month, which is pretty fantastic. And if you're looking at doing this, there's a couple of things we really want to underline with this Fast 50. These are higher volatility pairs, so please start with very conservative position sizing, 1,000 a leg, 200 or 2,500 a leg on a bigger account. Very conservative position sizing, or just paper trade it and allow one to get a feel for the risk and volatility that are inherent in this new set, because they're very different from the top 30. You're going to be getting 2, 3, 4, 5 signals a day, and as I say, up to 33 trades a month. So you may have 20 or 25 or 30 pairs on at any given time. And finally, we always say this, but even more important now that you're doing so many more trades, very tempting just to go in and have a quick screen and say, I'll put it on. Always check the news, filter out signals deriving from fundamental value shifting events, and avoid earnings releases and dividend dates. Even more so important with these pairs because they're higher volatility. Remember that. So that's the Fast 50, everyone. Hope it's something that interests you. We look forward to welcoming new subscribers to PairTrade Finder Pro. And of course, all existing subscribers get to download these Fast 50 as part of their ongoing annual subscription. Happy trading, everyone.